And welcome back. You're watching KTN Prime. Time now to take a look at some of the top stories making headlines in the business world. My name is Abi Agina. All eyes were on the Central Bank's Monetary Policy Committee today as they mulled over the state of the country's financial markets and debated whether or not to tighten the monetary stance. And for the second month in a row, MPC retained the best lending rate at 11.5%. Adelaide Changole tells us why they opted to take this route.
The primary function of any central bank is to maintain price stability, a function that is usually tied to a stable currency. It was therefore an unusual set of data that were presented to the Central Bank's Monetary Policy Committee as they held an unprecedented 7th meeting this year. On one hand, the country's inflation levels have dropped to 5-month lows of 5.84%, supporting the argument that the previous 2 increments to the central bank rate were bearing fruit. On the other hand, however, the shilling has remained on the back foot owing to the recovery of the U.S. markets, making a case for higher base rates.
Expect them to raise rates. We think they're going to, leave the central bank rate and change that 11.5%.
The inflation rates have relatively been coming down to a level of about 5.8%, and we've seen relative stability on the currencies front.
And at 5 p.m., the FPC announced its decision to retain the base rate at 11.5% for the second month in a row. In the statement, the MPC said core inflation had reversed its upward trend for the first time since April, falling from 4.7% in July to 4.5% in August, thanks to lower food prices and falling demand brought about by a weaker shilling.
And local maize prices have also started to stabilize somewhat. On the basis of that, I don't think food inflation is a big concern, but obviously the risk of El Nino rains on the horizon is something that could derail the outlook for food inflation.
The shilling has also stabilized after touching a 4-year low of 106 shillings and 75 cents 2 weeks ago to trade at 105 shillings and 70 cents to the dollar today. The CBK attributed this to tight liquidity conditions, which have seen the interbank lending rate rise from 15% at the start of September to 25% today. At the same time, the state has begun accepting higher bids for its treasury bills, a fact that has made the government debt attractive to investors.
The fact that, they've let treasury bill rates rise quite a bit, the market to a large extent now anticipates that portfolio flows are around the corner. So, you have the market sitting square and not being long dollar in terms of their positioning. So that's really where the broad stability for the currency has largely emanated from of late.
However, these interventions have come at a steep cost, with the country's foreign exchange cover reducing from $7.4 billion or 4.8 months cover to $6.1 billion or 3.94 months of import cover. On top of that, the higher bids mean the state will have to pay more to access debt, a fact that will heighten the country's debt payment obligations.
So the more we see currency volatility, it means that our debt paybacks in USD increases by its nature. So that means the coupon payments for things such as the Euro bond are continuously going up. But Kenya was not the only African country holding its Monetary Policy Committee meeting today. Nigeria and South Africa were also reviewing their monetary policies as they sought to ward off the impact of the Chinese currency devaluation and the rebounding dollar on their currencies and economies. Analysts expect all the countries to retain their base lending rates, thanks in part to the decision by the U.S. Federal Reserve Bank to hold off on raising its base rates. Anticipation alone has already produced some negative sentiments on emerging markets front. So the longer it does delay, I do think the more likely people are becoming more anxious, just awaiting the Fed rate hike.
On the emerging market as a frontier market, we kind of hope that the U.S. would finally start the tightening cycle and put us out of our misery, because the market would start to price it in.
Adelaide Changole, KTN Business.